We are officially live on YouTube for the Tuesday edition of the Not Your Average Investor Show. We are talking about the 3 places savvy investors find capital to invest in real estate that average investors don't know how to use. I'm your host, Pablo Gonzalez. With me, as always, the man that I affectionately like to call GC because of his genius concepts, because he knows how to generate cash flows, because he's a great co-host, and because his name is Gregg Cohen.
Hey, everybody.
Hello, Greg.
Hello, how are you? Nice to be with you. Thanks for having me.
You jumped the gun, man. You always wait for me to cue you up there.
I don't know what you're doing.
Our community manager. They call her MTM because she brings us the moments that matter, and because her name is Madison the Magnificent. Say hello, Madison.
Hi, everybody.
And if you are just tuning in on YouTube and you're wondering what we were talking about, we're going to talk about it a little bit more. If you're listening on the podcast, more likely. The thing is, we are a real community out here, right? We're a bunch of folks that love hanging out with each other. And we just recently got together and we got to meet a whole bunch of people that you're about to hear on what, GC?
The roll call, baby.
Roll call. Let's go. We got Shannon Baker, touchdown maker, who was in the house on Saturday.
Yes, she was.
First, we got Nadeem Shaw. Good morning, good afternoon from the West Coast. Finally got to meet Nadeem all the way from Seattle.
What a special individual.
Cool dude.
Yeah.
I'm a big fan. We got the early bird, Dean Curry, checking in from Columbus, Ohio. Sorry he could not attend, but he did make his 8th purchase with JWB last Friday.
All right, Mr. Early Bird. Way to go.
Love it. We got Christopher Lee from Fernandina Beach. Christopher Lee, welcome back to the show. We got Deborah Schwartz, who was one of the select few that saw me lay it all out on the line.
Dad made it out, huh?
Deborah made it out.
Fantastic.
I think she said something like, "Oh, we now see the real Pablo."
Deb, I would love to get your impression of Pablo rocking the mic in karaoke.
We got Bob Wiesner, my friend from Marietta, Georgia, who rode along with me for a little while on the way to the live POT dub.
Bob sent in a special email to us both. And Bob, we read your email to our entire team. Really means a lot. Thank you for that special note. Awesome to hang out with you.
We got Lee, the MVP Bishop, who kept on asking me, Pablo, what do I tell people when they ask me why I'm the MVP? What would you say to that, GC?
You know, you spend a few minutes with Lee in person and you understand.
Yeah.
Remember when we were telling him he was getting challenged for the MVP status?
Yeah. Yeah.
He brought the heat.
He held it down.
He brought the heat. It was awesome hanging out with Lee and with his beautiful wife, Jane. I mean, it was amazing.
What I was really impressed by, Lee is a world-class physical comedian, and I love physical comedy, man. I could not stop cracking up. It was awesome, Lee. Great hanging out with you. Amazing origin story of their relationship.
Yes.
You gotta get it from Lee direct. I don't want to take that from him. Amy Matthews, who we got to make friends with, she's in the house.
Amazing.
Amy, it was great talking to Amy and listening about her investor journey and all that stuff. Mary Rockoff is in the house from Arizona. Good morning to all. Good to have you. Danny Davis checking in from Germany with a Guten Tag.
Guten Tag.
We got Leslie Wilson, who was our expert panelist, came in all the way from Denver. Got to hang out with Leslie for the second time because we met her at Fortune Builders.
We did. Never enough, though.
Yeah.
Never enough. Got to meet Leslie and her friend as well, who came. I mean, it was awesome.
Yeah, right, Chris. Super interesting guy who's like been all over Europe and has some crazy like stories in Dubai. Yeah, it was really fun.
Mm-hmm.
We got Misty Johnson, past star of the show. Checking in with us. Good to have you, Misty, from Denver. Misty, I'm coming to Denver. I just booked tickets for the podcast movement. It's in late August. We'll talk about that later because I want to hang out with everybody. Walt Hart in the house. He's back saying, "Hey guys." We got a not your average guest. Somebody, if you check in from the cell phone, we don't know what your name is unless you change it, saying hi, but it's good to have you no matter what. Sarah Jennings checking in from New Jersey. Is that a new name?
New name?
Sarah.
New name. Welcome to the party.
Welcome to the show, Sarah. Love to have you. We got Tara Klein in the house.
All right. Now we're talking from my team.
Yeah, we got the patriarch and matriarch of the first family of the Not Your Average Investor shows, the Malines, Ken and Carolyn.
We salute you.
We got our favorite name to pronounce, Aaron O'Neill.
Into the light.
Aaron was ripping it up out there, man. Aaron, it was great hanging out with you. And we got the ringmaster,
Drew Barnhill.
Drew Barnhill, who was not able to make it this weekend.
Yeah, where was Drew?
He's in busy season with that season, man.
Right.
But we talked about him a bunch.
Yeah,
we missed you. We got Verinder Kumar. Verinder, welcome back to the show. Haven't seen you in a while. Good to have you in the house. David Blattner in the house as well. Let's kick this off, GC.
Let's do it, baby.
All right, man. We were, little spoiler alert, we're putting together this class, right? This like rental property investing 101. I'm researching around other classes, and I like to steal like an artist. No big deal, right?
There you go.
Somebody's done it. You might as well learn from them and do it however you want to put your own spin on it. And we realized that there's this other class I was talking about, these places for capital that we just don't talk about enough on the show, right? So we found 3 places where you have capital, you likely have capital or the opportunity to find capital that you can put into rental properties if you don't have a bunch of cash laying around or in some like stock investment or whatever, right? First one, and this is the one that we borrowed from our New Zealander friends. Home equity, right? Like anybody who's bought a home in the last like 4 years likely has a bunch of equity in that home. But we're going to talk for each one of these, who it's for, why it works, mistakes to avoid, and how to do it, right, GC? So let's talk about home equity. Who's it for? Who would you recommend does this?
Well, so we have to think it's beyond people who just bought in the last 4 years, right? I mean, home values started to increase in Jacksonville around 2011, 2012. And so if you bought a home anywhere, geez, in the last 10, 15 years, you likely have a significant amount of equity, even those who bought just a year ago or 2 years ago.
Really? You think within 2 years might be enough?
Yeah, I do, because home values went up 15, 20% for 2 straight years in Jacksonville. I
guess if you have a $400,000 home and it went up 20%, you have $80,000 worth of equity, which is enough for a down payment
we'll kind of go through the math because it won't line up exactly with what you said right there, but that's why you need me around, right?
I got excited.
General concept, absolutely there. And if you bought 2 years ago, that was 15, 20% for 2 consecutive years. So it's pretty much double what you just laid out there. So
I was way off.
You were way off.
Continue. So who is it for then?
So it's for anybody who owns a primary home. A very common question is, can you get home equity lines of credit on investment properties? The simple answer is no. It is extremely difficult to find home equity lines of credit on investment properties ever since the Great Recession. Prior to the Great Recession, it was a thing. So we hope at some point that it will be done responsibly and that will open up for home equity lines of credit on investment properties. But simple answer is no. But here's something else that you all might be thinking, or, you might say, well, listen, I don't own my primary residence, right? Maybe this isn't for me. We, as an economy now, collectively, we have more home equity now than we've had in a long time, right? With the type of gains that we've had in pretty much every city in the country. And so when you're thinking about how you can get started, if you're saying that money is the problem, I just flat out really don't believe that. Because if you look either in your primary home that you have or in your network, it is really likely that somebody that loves you and that wants you to be successful and that may even have an interest in investing with you alongside you owns a home. And so you can look to home equity lines of credit, which is a way of tapping into your home equity that has been built up between you and between your network. And you probably can take that money excuse off the table if that's what's been holding you back.
Okay. All right. So I think, the last one that we're going to talk about is partnerships, right? So that's going to be there. But so home equity, when you have equity in your home, right? You've paid something for home, it's appreciated, and you've also likely been paying down your mortgage as well, right? So both that pay down and the appreciation stuff works in your favor to have equity. We like to talk about turning equity into income. So there is, I think, 2 ways of doing it, right? There's the home equity line of credit, which we can talk about. But there's also the idea of a reverse mortgage, right? So like Ken Moline famously has used a reverse mortgage to build up a whole bunch more cash flow than he normally thought he could late in life in his retirement as well.
Exactly. And that's a type of home equity loan, right? So a home equity line of credit is a line of credit. It is there if and when you want to use it. When you don't use it, you don't have to pay anything for it. A home equity loan, or a type of that as a reverse mortgage, is an actual loan that you take out. So you get this lump of cash, and then you, of course, are paying interest on that, no matter if you use that for an investment or for something else or not. So both of those, or all 3 of those, can be used to access equity. But, I think when we talk about accessing equity, sometimes it has sort of a negative connotation, like we're being super risky and all of these good things. Can we kind of like talk about what equity is just for a second, really?
Yeah, let's talk about it.
If we have a goal to get to financial freedom, or whatever that is for you, right? You need to be thinking about the tools that you have to get there. And one of the tools is your active income, right? Your job, right? The money that you earn from your active. That's a tool, right? Another tool will be your passive income, right? Maybe income that you've earned from making investments in rental properties or in other things that are producing passive income from you. That's a tool. Well, another tool that you have is equity in your home. And the simple act of taking out debt on your home does not mean that it's risky. Now, there is a risky way to take out debt on your home that I do not advocate for folks, but there is a lot of risk mitigation in a way of taking out equity in your home that you can do. And you don't have to feel like this is a super high amount of risk that you're doing to take this on. But the reality is that home equity is something that gets built up over time. And if you're a homeowner and you've owned for multiple years in a full market cycle, you're going to have home equity in your home, and it's going to be significant. And so I would like to change just the thought process of being totally against using home equity to help you get to your financial goals, for the simple fact that if you do that, it's like you're trying to accomplish this idea and this goal of financial freedom, kind of with maybe not a full arm held behind your back, but certainly you're not using the tools to your full potential there. And the reality is it's really hard to achieve financial freedom for most people. So why not think about doing this in a risk mitigated fashion so that you can use your full set of tools to help you get there? And it's not something that you have to be super scary about.
Got it. Okay. So I think we're gonna hit on the risk mitigation and the mistakes to avoid side, right? But right now in why it works, correct me if I'm wrong. You have your house is worth a certain amount.
Mm-hmm.
Some of that is owned by the bank because it's part of the loan still, and some of that is owned by you because it's either appreciated or you've already paid down part of that loan. That part is the equity, right? Like that, the percentage worth of the home that you own outright. Mm-hmm. And you have right to that money.
More or less. I mean, when you own a house, mm-hmm. you own the entire thing.
Yeah.
Some people say that you don't really you own the house.
Okay.
The bank has a lien against your property, but you own it even if it's not fully paid off.
Got it. So the bank has a lien to a certain amount of your property, or at least there's a certain amount of that. The equity piece is something that banks will lend on, right? Because
yes.
if you default, then they can take the house, and that's very risk mitigated for them,
right?
Because it's a hard asset, right? So we're talking about that piece of value of your home. We're talking about taking either a line of credit out that they will give you a line of credit up to a certain amount. Is it like 80% of the equity?
Yeah, I'll share from my personal experience. So what I'm talking about doing, taking out a home equity line of credit, is something that I do on my own personal residence as a way to use the equity as a tool to achieve my financial goals. And I've been doing this for, as long as I can remember. And so the home equity line of credit that I have lends up to 90% of the value of my home.
90% of the value of the equity in your home.
Yes. Well, 90% of the value of my home.
Okay.
And let's just say that my home was worth $100,000. They'll give me a max loan on that of $90,000. Mm-hmm. And then whatever debt I have on the home already, making this up, let's just say I had $50,000 of debt on that home, then there would be $40,000 of a line of credit that would be available to me for me to be able to use for investable capital.
Got it. And what we're talking about is taking that extra part of the line of credit, which is lent to you at a certain interest rate, and putting it into a asset that returns at a higher interest rate than the interest rate that you're getting this loan of credit on, right?
Exactly.
That's the bottom line. So whether it's a line of credit, which is something that, whether it's a line of credit or a loan, it works the same way, right? It's essentially like borrowing money at a certain rate, putting it in something that makes more money than that rate, and therefore you get the spread with this money that you're using, right?
Yeah, exactly. At the end of the day, that's your job as a financial engineer, is to either use your money or to use other people's money and create that arbitrage, create that spread. So if you're borrowing at 8% and you're earning 14%, that's a spread. And then you're able to leverage other people's money, and that's how you achieve financial goals.
Okay. Sounds simple enough. Let's talk about the pitfalls of it. Let's talk about what you were just talking about. It sounds super risky, but there's not as risky ways to do it. What is the not as risky way to do it?
Well, I think making sure that you're in a home equity line of credit. So let me just start off a little bit here. So banks are going to make this risk mitigated for them. And when they make it risk mitigated for them, that makes it risk mitigated for you as well. What I mean by that is A bank's not going to allow you to over leverage your house with a line of credit or a loan. And so the riskiest way to do this would be to take out way more money on your home than it's worth. And then you're starting to get into some risky business. So that's not what we're talking about. And banks make that easy for you because they don't want to take that risk either. So what you're going to do is you're going to borrow a percentage of the equity in your home. So what that means is you're not borrowing the full amount of your property. Now, one thing that people can do, which is where they get into trouble with home equity lines of credit, is they go and take out a home equity line of credit and they invest in either super risky assets or they just spend money on liabilities. They go spend it on vacations and big screen TVs. I'm assuming that our folks that are listening to this right now are not thinking about that. So
wrong way to do it is to take that money out and go buy something with it.
Right.
Or take that money out and put it in like crypto or a stock bet or in a Vegas casino, which is about the same amount of odds, right? Like, and just doing something like that. Right?
Yeah, exactly. Because this is one that is tied to your primary home, right? Now, that doesn't mean that you can't use it, but at the end of the day, you don't want to put it in something that you would define as risky because ultimately it's your primary home. You need to take an extra thought about the asset that this money is going into and make sure that it has a historical track record that is consistent, like rental properties does.
Okay. So let's talk about that, right? So you're saying you don't want to put in a risky asset. How would you rate a non-risky asset that is worthwhile investing in with something like this?
How would I rate a non-risky asset?
Like what is the right thing to put that into? What is the wrong thing to put that into?
I think individual stocks is the wrong thing to do, especially right now, as the stock market is still overvalued. The stock market's lost 15% from where we were last year in the beginning, the previous highs. And what people don't realize is that the worst is probably yet to come. When you in a recession, over the last 12 recessions, the average loss in the S&P 500 is 30%. We haven't even reached a recession yet. So I would say, do not make individual stock picks. I'd say the market overall is probably not a good thing for you to take your home equity and put it into the stock market right now. I'd also say bonds does not make sense too, because their interest rate that you're paying on your home equity line of credit is going to be higher than what you typically are able to receive in a bond, a treasury, or a corporate bond. So stocks and bonds don't typically.
So the math on bonds wouldn't work out. The risk on stocks doesn't work out.
Right.
Is this something that needs to pay you cash flow monthly? Is it something that needs to pay you cash flow yearly to make the equation work?
No, this is about accumulating assets that are going to pay more in an internal rate of return over a full market cycle than the cost of the debt, than the cost that you're paying. So like an asset, if in a typical, and I just looked this up prior to the show, the average rate for a home equity line of credit right now is between about 7 to 8%.
Okay.
That's a variable rate, which means that has gone up significantly as the Fed has raised rates. And at some point when the Fed scales back and drops rates, that rate will also come down. So if you're borrowing at 7 or 8%, you need to make more than 7 or 8%. And you got to feel really good that it's consistent. So there's not a whole lot of assets out there that kind of check both of those boxes. Obviously, rental properties is one that does, and one that I would advocate. So, but at the end of the day, rental properties right now, if you're listening on the Thursday shows, you see that typically 13%, 14% IRRs on a 10-year schedule. Means every year for 10 years, 13% on your money, you're borrowing it at 8%. Next year, 13%, you're borrowing it at 8%. That's how you're accumulating wealth, and you're doing this with other people's money. The cash flow question though, let's talk about this. Does this need to accumulate positive cash flow for it to be a win? No. Right? If you didn't do this, you were not going to be accumulating positive cash flow. Correct. Right? So positive cash flow with this investment using a home equity line of credit, it is not a major requirement.
Does it need to break even on cash flow?
So let's talk about that, because that's another thing that we need to talk through, right? You know, your typical property right now in your first year, call it break even, or maybe, I don't know, $50 a month or something, somewhere like that. $25 a month, $50 a month for your typical recurring expenses.
25% down.
Yeah. So you're not getting a whole lot of cash flow, which is fine. If you were on the tour on Saturday, we talked through and we said, listen, a property that breaks even still beats the stock market over the last 20 years, beat it by 44% and accumulates much more cash flow over time. So, but the thing about it, a home equity line of credit is you're going to be paying the cost of that debt monthly. So what's going to happen is you're going to kind of earn a little bit of positive cash flow with a JWB rental property, but then you're going to have more expenses because of that debt, that call it 8% that you're paying on that debt. So this is something that you would go cash flow negative overall in the short run while rates are this high and while your cash flow hasn't built up as it does over time. So in the immediate run, you're going to be cash flow negative. So that's something that we need to plan for. You need to have either reserves or you need to have enough additional income from other sources to offset the cost in the short run, because when you factor in the debt cost of the home equity line of credit, it will take a cash flow negative property. It will take it from positive cash flow to negative.
Got it. Okay. So then now what we're looking at is, so if this is the how to do it section, right? One of the things that is on the how you do it part is you need to do the calculation of where rates are today and how your cash flow is going to perform on a monthly basis, and have the reserves that you normally have for rental properties plus extra reserves for the timeline from now until that cash flow equation turns into a more positive scenario, which could be maybe it's year 2 because the lease has escalators, or year 3 because it has escalators. It could be after a turn when the rent goes up even more, but essentially it should happen at some point in the first like 5 years-ish.
Yeah, I think that's a good estimation, but there's another point. I think where this works really, really well, you can accomplish it a couple different ways. You can plan for extra reserves like you're talking about if you don't own any rental properties or if you don't have other passive income to offset it. But where it works really, really well is if there's a client that owns 3 rental properties already, and let's say they've owned those properties for 5 years and they're earning $200 a month, $300 a month, maybe $400 a month in positive cash flow from each of those properties. So they've built up enough to offset the debt cost that will come from this new investment. That's where it can really work well. So think about it in one of 2 ways. Either if you don't have other passive income to offset the cash flow negative expense, plan for that. And 5 years sounds great. We can sit down and we can map it out for you. This is what we do for all clients or new clients coming on board. So happy to do that. Or if you are a client that has already built up significant passive income, think about that offsetting the negative.
Yeah.
The debt cost.
Cool. And we got a not your average. I'm assuming it's Denny saying the numbers Gregg is talking about do work, but from a psychological perspective, this is a hard trigger to pull. Intentionally going negative cash flow for an investment transaction, which is I think why you're bringing up the idea of if it's already going to be absorbed by the cash flow of the rest of your portfolio, it's a little bit easier to do, right?
Yeah, absolutely. It's definitely going to be easier to.
And then Ken Moline is also saying, so this is for either one, the line of credit or for the reverse mortgage, right? At the end of the day, how to do it, you have to have these reserves, you have to have this planned out. But beyond that, it's just call your bank, call any bank, or is it the bank that has your mortgage?
No, you can call any bank. So the bank that I use here locally is not the bank that has my mortgage. Local credit unions, local banks typically work the best. When I had my home equity line of credit, the first one I did, they didn't even charge me for an appraisal. They didn't charge me any closing costs. And it went up to 90%. No, I think it went up to 100% of the loan to value at some point. That was a number of years ago. Now it's 90%, and they charge me some fees. I think they charged me for the appraisal. I think due to the amount of the home equity line of credit that I have, they charge me some closing costs. So I don't know, do your best. See if you can get the appraisal covered for it. See if you can get the closing costs covered. I think you probably will if you call around, but it's really simple. It can be done. And what I'm actually doing now, something on my list of things to do for myself, is to increase the line of credit that I have on my personal residence. So you can do that over time as values continue to raise like they have here in Jacksonville. You can go back and say, well, it was this amount when my home value was this. Now my home value is this. Can you increase the loan amount on the home equity line of credit?
Sweet.
Pretty simple.
Okay. All right. So there you go. So who is this for? Oh, and then Ken Moline is saying a jumbo reverse mortgage allows you to borrow up to 50% of the appraised value of your home You must pay off all existing mortgages, but the rest of the borrowed money is yours to use however you want. That's where we generated funds to invest in their first 8 JWB homes.
Very cool. Very cool.
Cool.
I didn't know the specifics of that reverse mortgage. That's really cool.
Yeah. So home equity line of credit, reverse mortgage, there's lending apparatuses that can lend you on your home. If you've owned your home, maybe even if you've only had it for 2 years, you might have enough equity in there, but definitely if you've had it for like 6 to 12, 15 years, you're for sure got a ton of equity in that thing. If you haven't leveraged that yet, you want to do, that is who this is for, people that have equity in their primary residence. Why it works is because you can borrow money at a certain rate and invest in money at a higher rate than that. And you are a financial engineer making that spread while paying that down. Mistakes to avoid is make sure that it is a consistent asset that doesn't have a lot of volatility, right? Doesn't have downside like individual stocks or crypto, stuff like that. It also has to be returning at a higher rate than what you're borrowing. So bonds generally don't play in this scenario. Rental properties do. And how to do it is you call up your bank. You do that first. You do the math of what the cash flow is going to look like on a month-to-month basis, and when you start to break even based on interest rates and the spread of what you're making. Call up your bank, get the best loan you can, try to get them to give you free closing costs and all that stuff. And most banks are really interested in this kind of product.
Yeah.
Oh.
Let me add one more thing, 2 more things maybe. When you're doing this, the best thing that you can do is to use your home equity line of credit for the down payment only. Some folks think that they are going to use their home equity line of credit for the entire purchase. You typically don't want to do that. Your long-term loan should account for, call it 75% of the debt that you have. And then depending on the home equity line of credit you have, that might account for all of your down payment or some of your down payment. And I think Denny's point was really powerful, right? This is something that can be a negative cash flow situation. You have full ability to kind of control that, know that going in. Like, for example, if you want it to be break even, maybe you borrow half of the down payment from your home equity line of credit and you bring half in your cash to do it. The other thing to consider here is that rates right now are higher, right? What's going to happen, and one reason why I think this is still a good thing to do for the right person, right? It's not for everybody, but for the right person out there, is because in the coming years, we expect your rate on your home equity line of credit to come down, and we expect rents to continue to go up, all while your other expense, meaning your mortgage, is flat. So you're creating more cash flow on the positive side, and we expect rates to come down in future years. So this is a temporary negative cash flow situation. And then one last thing, people who do this generally already have a plan in place to pay off that home equity line of credit. I think that's really important. So they might say, well, I'm cash flow negative $200 or something like that a month. Let's just say a pretty large number. Well, in their active income, in their normal way of conducting their individual revenue and expenses, right? Money they earn from their job and the expenses, they might plan for an additional $2,500 from their active income to go towards offsetting this negative temporary cash flow situation. So all of this can be strategized, right? It's the concept here is, think of this as a tool, and let's find a way for this tool to work so that you are prepared if there is a temporary negative cash flow situation. But this is a tool that can prevent you from saying, I can't do this.
Yeah.
So
and it sounds like in what you're saying, it allows you to pull forward some demand as well, right? Like if you have a plan to pay it off, but you just don't have the cash to get into a rental property right now, and at the end of the day, it's like you want to buy real estate and not wait to buy real estate.
Exactly.
You can just pull that trigger and then start paying that thing down, and you're getting all these other benefits in the meantime. So
exactly,
you're able to jump on that. For example, like if, let's say there's a $10,000 buyer credit out there somewhere.
Well done. Well done. That's right.
All right, cool. So that's number one. That's home equity as the main way. That was one of the key ones we really wanted to talk about. Thank you for explaining that, because we haven't talked about that much on the show. Number two is your retirement account, GC. So, who is this for?
Well, this is for anybody that has funds in a retirement account. It could be company 401k. It could be your IRAs, your solo 401ks, your 403bs, any of these other acronyms of different retirement accounts. If you have self-directed IRA already, which we can kind of talk about what the difference is there, any type of retirement account, that is money. Those are tools, again, that can help you decrease risk, diversify, and increase your passive income when you need it. Many people aren't aware that you can invest from your retirement accounts in real estate. You absolutely can. I have done this. Hundreds and hundreds of our clients do it right now. And so it's another tool that can be used.
Okay, great. So basically anybody, right? When I think about it, I think of you've switched jobs a couple of times. You probably have an old 401k somewhere that you translated into an IRA or not, right? Like that's kind of like right for all that stuff.
Sure.
Or if you're an entrepreneur, you have this stuff. There are people that are like actively employed and have a 401k. Is that available to them too? Like inside like a company 401k?
You're gonna love this answer. Yes and no.
Okay.
Okay. So when you are employed and you have a 401k with that employer, it's going to be very rare for you to be able to use that company sponsored 401k plan to invest in rental properties or private lending or anything outside of the stock market. So, but here's the thing, many people aren't aware of this. And again, this is what I do as well. The company 401k that we have here at JWB does not allow me or anybody to invest in real estate directly. Shocker, right? Yep. It's unfortunate, but it's really, 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 really rare that there's a company sponsored plan that allows you to do that. But what I do, and the way that you can use your company 401k to find capital to be able to invest, is that you can take a loan against your 401k. And so for me, right, I'm allowed to borrow up to 50% of the value of my 401k, and it's a loan from Gregg's 401k to Gregg the individual. And so Gregg's 401k lends 50% of the value of my 401k. Gregg the individual repays Gregg's IRA every single paycheck that I get. And I, as an individual, I'm receiving a lump sum of capital that I can do what I want to do with. I can make an investment, right? Hopefully you're doing things like that versus going and spending on things that don't make sense, but you have the ability to use this capital now, and it is not restricted like your company 401k assets are while they're in the company 401k plan.
Got it. Okay. So I think for this one, since it's a little more technical, let's jump straight into how to do it, right? Because we talked about two different things. One is having a solo 401k, and another one is taking a loan out on a 401k. Let's start with like the self-directed 401k. How does it work there?
So this term self-directed, many of the big brokerages use this term now. It's become kind of a buzzword. Your big brokerages, your Fidelity, your E-Trade, Merrill Lynch, those do not offer the type of self-direction that you are looking for. They will not allow you to actually invest in direct ownership of real estate or private lending or anything of that nature. You have to work with a true self-directed IRA custodian. So the company that I use is New View Trust. I have a great relationship with them. Many of our clients do as well. There are a number of other ones out there. When I say there are a number, actually, the number's kind of small.
Yeah.
It's kind of a small
It's like 5 or 6, right?
Yeah, there's 5 or 6.
Yeah.
There is a number.
Yeah.
It happens to be a small number.
It's a single digit number.
And so you have to work with them. And what they do is they found a niche where they're willing to allow you to invest in alternative assets, and they allow you to invest in direct ownership of real estate. And so that's what you do. You have to work with one of them. I mean, you certainly can reach out to us for a recommendation or a referral to our friends at New View or the other ones. I've pretty much put my money or have worked directly with all of them out there. Mm-hmm. And so our team can certainly advise you, but it starts with a phone call. And then what you do is you roll over your account from a different IRA. Again, this is not your company 401k plan. You can't do this while you're still employed. These are those other IRAs or solo 401ks that you've created and that are not tied to your place of employment. You roll those over to the custodian, just as if you were rolling it over to Fidelity or rolling it over to E-Trade. It's the same concept. They perform the same function. This self-directed IRA custodian allows you to invest in alternative assets.
Awesome. Okay. And then within those, there's kind of like two ways of doing it, right? Like you can take the money that you have in there and buy a property straight cash.
Sure.
Or you can get a non-recourse loan inside of that retirement account that they give you. They give you a loan to buy a house 30% down, 40% down, something like that.
Yeah, I would say plan on 40%, maybe even 50%.
Yeah. And you've also told me that when you do it inside of a retirement account, all funds need to stay inside of a retirement account. So you have to, I guess this is part of the mistakes to avoid. You have to have enough reserves and enough capital to be able to like endure a turn, endure some maintenance, stuff like that. So you might want to have like a heightened reserve in there because you can't use other funds that are not in there in order to like fix the property or something.
100%. The stakes for understanding and making sure you have enough reserves are higher when you invest in your retirement account, because if you get to a situation where you have a big property turn and you don't have enough money in your retirement account and you've already maxed out your contribution for that year, you cannot spend more money to fix it. Like literally the property has to sit there. And that's a terrible situation to be in, because you might have an asset that can't be rented out because it needs to have a property turn, but you can't literally, contribute the money to get there. So it's not to freak you out. I mean, that's a worst case scenario. There's so much that can be done to avoid that. But the point here is making sure that you have ample reserves, more reserves in place when you're investing with your retirement account is the point here. And obviously we help you do that.
Okay, cool. Charles Thurman had a question earlier that I think it's very applicable now. What rate is your lender offering for these non-recourse loans for 401k borrowers? And will your properties cash flow with a typical non-recourse loan?
I think the rates are somewhere around 9% right now. I could be off a little bit there, Charles. I would just ask you to reach out to the team. We can get you a great answer on that. And no, typically there's a little bit of cash flow negative, maybe slightly break even, somewhere right around there. So again, it's that same conversation with the home equity line of credit. We can make sure that the way that you're doing this gets you to a place of cash flow positive. Like the lender will typically allow you to take, call it 50% of the value as a loan, right? And they'll allow you to have that 9% interest rate or, that term, but we can make sure that your actual cash flow is break even, and we can change the terms of that loan. Well, we can't change the interest rate, but we can change the amount down, and we can make sure that this is something that you're going to be either cash flow positive with that property, or another thing. And this is what we do a lot of times.
That's what Lee said, right? Putting 50% down or 40% down sometimes can make the cash flow positive.
Yeah, exactly. So if you put more down, then you have a better chance for cash flow positive, right? So you might be able to do that. But here's something even more common. So a lot of times people will have, in their estimation, they have too much money in the stock market. And they look at their retirement capital and they say, oh, geez, that's 100% in the stock market. I don't want that right now. So they bring over a large sum of money into rental properties and they say, I'd like to buy as many properties as I can. And so how do I do this? And without taking on too much risk. And so what we do is we do a combination. We might say, okay, well, we're going to buy one of these properties in cash in your retirement account. So you have, call it $1,200 a month net coming to you. There's no mortgage on that one. And then you might buy another 2 properties that have leverage on them. And so those 2 properties, let's just say that I'm throwing out numbers here. Let's say it's $100 a month negative. Well, if you have $1,200 a month positive coming in on one property and you have $200 a month negative coming on the other 2, well, that's certainly a risk mitigated portfolio. So again, the goal here is to make this work for you so that it's risk mitigated. So many ways to do it here, just like so many ways to do it for the home equity line of credit conversation.
Yeah, that makes a lot of sense, man. Is it the same with so the other thing that we mentioned was the loan, right? The loan against your 401k. Is that the same thing? It has to be self-contained, or does that just now become part of your regular portfolio and leverage the same way as like a home equity line of credit kind of thing?
Got it. So you're saying that money that now we're switching
Yes.
terms.
So now we're not using a non-recourse loan. We're not talking about you taking your IRA and directly buying a home,
right,
or getting a loan to buy a home or any combination thereof.
Not talking about that.
You are now getting a loan based on, you have, call it $500,000 in your 401k. You get a loan for, what'd you say, 50% of that is something that to do. So let's say you can take a $250,000 loan out. How does that one work?
So for that one, you have that $250,000 that does not have any of the rules or limitations that your retirement account properties have. That's just the same as you being able to use that for a down payment.
Mm-hmm.
What you do is you then just go to your conventional bank, just like we would normally do for any of our typical purchases that are outside of our retirement accounts. You get the loan from the conventional bank. And let's just say you've got $250,000 of capital to work with. You buy 3 properties. You had 3 times $75,000 is roughly $225,000 right there.
Mm-hmm.
And so you now have 3 properties that you used your retirement account capital on. You're not paying somebody else 8% on that money. You're literally just repaying yourself later on your retirement accounts. And now you have 3 assets that are now cash flow positive for you.
There you go. So that performs more like that home equity line where you just need to know that the interest that you're paying on that thing is going to be less than what you're making, and you are investing in risk mitigated assets.
Well, it's a little bit different. You got to think. So like in the home equity line of credit, you're paying somebody else 8% interest.
Mm-hmm.
So you earning 14% and paying somebody else 8 at this moment, which over time should go down. That's a good trade to make, right? On a consistent asset, on a non-risky asset. That's a good trade to make. What we're talking about here, who are you paying this interest to in the loan from your company 401k?
To your own 401k.
You're paying yourself.
Okay.
You're paying yourself later.
Okay.
So it makes even more sense to do that. It's a way to diversify out of the stock market for sure. And then the internal rate of return you're earning is more compared to like what are other market alternatives that you could have earned with that 250 grand that we just talked about in this example. Does that make sense?
Yeah, that makes sense. That's cool. All right. So this feels like it has an even more wide breadth, right? Like it's less risky or at least it's less complicated. There's more margin because you're paying yourself anyways. So basically I would assume anybody that's been working for like 10 years and using their 401k probably has enough in there to borrow against it.
I don't know. I don't think the 10 years has to be there. I mean, a lot of folks are just, call it $20,000 down away from investing in their first rental property.
Yeah.
You don't have to work for 10 years. And we have a lot of high earners that listen to our calls and whatnot. I mean, if you've been working at a job for less than that, I mean, just take the value of your company 401k and multiply that times 50%. And if that amount is the missing piece for you to put your first down payment down, this can apply to you.
All right, there you go. Cool. So we got 10 minutes. Let's hit partnerships, GC.
Love it.
I know that this is how you got started, right? Tell me, who was the partnerships? Who is this for?
I mean, I think anybody can do this. There was nothing about me at 23 years old that said that I was more likely or destined for success with a partnership or anything in real estate than anybody else. I just, I wanted to create a situation where somebody else could benefit and I could benefit, and I could start my real estate journey early on because I learned the power of investing in this asset class as early as possible. The compounding effects of this asset class are what makes it great. So I became, really passionate about how could I create a win-win for somebody else so that I could get these assets in my portfolio in my 20s. And anybody can do this.
Is this something that generally works more for active investors and passive investors?
I mean, generally, I would say the application is more for active investors than for passive investors. You see a lot of people partnering up to be able to go and flip houses and things like that. So I would say it's more common, but there's nothing about it that has to be for active investors versus passive investors. And I would think the benefits long-term are even greater for you as a passive investor to get these assets in your portfolio and to, and create a win-win situation. Because again, this is not you just taking money from somebody else to buy a rental property. You're creating a better situation than they have for the money. Like an example, right? Right now, a lot of people have money in the stock market and they're really scared. And, the data suggests that there's going to be some more pain to happen in the stock market. Pain in the stock market means that values are going down. Capital will be lost. If you can create a scenario where you can partner up with somebody, they can provide the capital that would have been in the stock market, which they may believe that there's a chance that would have gone down in value. Not only are you benefiting from being able to acquire an asset and put it into your portfolio now, but you're also benefiting them because they didn't lose the money. and another portfolio. Like when I started, the first person I partnered up with was my dad. And when I found my first real estate property, I think the thing that you should do is go to your cell phone and look and see, okay, who are the people that know, love, and trust you? And who are the people that are invested in your success? And if you find any of those people who also have had conversations in real estate with you, like that's a great person to go and talk to. And, for me, that was my first person. I thought it was my dad. Yep. Checked all those boxes. Yep. And, at that time, stock market wasn't in the place that it's in now.
Yeah.
So when I went to my dad and I said, hey, listen, Dad, you've got this amount of capital. It's in the stock market right now. If you let me borrow this money and I'm able to buy this, it was a condo in Jacksonville Beach. I said, I'll pay you an interest rate that's higher than what you're likely going to earn with that money that you were going to earn in the stock market. And so, the reality is my dad did it because he loves me and he wanted me to be successful and he wanted to be the one to give me my first break. And so you'll have some of those people in your cell phone who just meet that criteria. And then, he wasn't doing it to make money, but I wanted to create a situation where it also made sense for him from a return perspective. And I bet for many of you who are listening to this right now, again, if you go through your cell phone, look to those people that know, love, and trust you, that are invested in your success, and that have had some conversation about real estate, you're going to find somebody who checks that box.
That makes sense. I also think about when you're creating these win-wins, right? Because I've had these conversations. I think about the person that has capital, but they're an entrepreneur. So their K1 every year is basically showing that they're not making a lot of money. And what they need is somebody with a W-2 that has credit, that they can combine the like the capital to invest with the line of credit. And both of those people can create a symbiosis, right? Like I can be the 27-year-old that's had a job for 5 years and can qualify for this, but I haven't saved 60 grand. Mm-hmm. And I can go to an entrepreneur who's killing it, wants to make some passive income and say, hey, use my credit we'll both invest in this property and we're both going to get the benefits of this property and partner up that way.
100%. Right? I mean, that was me when I started. I had good credit. I didn't have any money for a down payment. So I went to the money partner, which happened to be my dad. Yeah. Right. But it's the same thing, right? How many of you have heard of there's a money partner and then there's an active partner, right? You can create that same type of relationship and it can be a win for the money partner and it can be a win for you, of course.
Got it. Okay. So that's how that works, right? Like you find this way to do it and you partner up. What other things? You need to paper up real good. Like you need to have a good attorney. What kind of, ways what do you have to go through to do it?
It depends on who you're partnering up with. I mean, clearly, it's my dad. So yeah, we didn't lawyer up, and so you'll be the judge of that depending on how close of a relationship it is that you have. If it's not somebody that's in your family or a super strong friend that you've had for a long time, I would always err on papering up because I think it protects you. That doesn't mean I think you have to spend thousands in legal fees to do it, but at least writing out what the terms of the agreement are, putting it down written. That's what I did with my dad too. We wrote it all out. So I think at a minimum, do that. And then, if it's truly a partnership and this is something that you're going to scale, I think, spending the money on legal fees is a great expense,
Got it. What are mistakes to avoid here?
Choosing the wrong partner.
Choosing
the wrong partner and choosing a partner for the wrong reasons. I think this is a partnership that has to go beyond who has the money or who's going to be putting more of the active management in place or who has the credit or whatnot, or who has the relationship. You have to make sure that, the core values are aligned, mm-hmm. right? I always like to think about have you had a negative situation with that person yet? And before I would go into a partnership, I would want to make sure that I had a negative situation with that partner first, because I would want to see how did we both act when things were not all rosy, because when you go into a partnership, it's not all rosy. You're going to have negative situations depending on the scale and the success that you have. And so you want to make sure that when times are not great, is this person going to think and act and behave the way you do? Yeah. And so I think that due diligence is more important than anything else.
Makes sense. So if I'm thinking about who this is for someone that is, has one part of value that they can bring to the equation and can find somebody else that can use that value, and together they can make it better. For example, someone with capital that doesn't have a W-2, so can't get a loan, or someone with a W-2 that doesn't have capital, they can get a loan and they need the capital. Why it works because it's a mutually beneficial relationship, right? Mistakes to avoid, find the right partner, make sure that you are in a risk mitigated asset, of course, so that you are trying to get a good experience. And how to do it is look in your phone for those people and reach out and get that process going, right? Is there anything when people bring, not your average guest, I don't know if this is Denny or somebody else, but if you checked in with your text, I don't know what the name is, but it says in the chat, this exact strategy is what made my wife and me millionaires via JWB, and my extended family benefited as well, interest on the personal loan. So does JWB, is this like call JWB and they can kind of talk you through it kind of thing?
Yeah, I mean, we're absolutely going to be able to talk you through it. It's going to be your job to find that right relationship though, and I just think that is possible. I know everybody says, hey, listen, I don't have this, I don't have a network. I tell you guys, if you don't have the network, it's not hard to create it. There's real estate investor associations in almost every market out there, Pablo and I, we have a network of real estate investors. It's called our Spike Ball team, our Spike Ball crew. We sit there, we talk about it. I lend private money to people that are in Spike Ball and other friends and other investors. So, if you don't have a network now, it's really on you. If you really want to do this, if you really want to get started, it's not hard to create in a short period of time. So, and then the other thing I wanted to add, and the Not Your Average Guest who just mentioned that kind of highlighted it. One of the things that I have found is that this partnership is one of the most, it is a really fun thing to do. So for example, a different type of partnership that I have seen done really well, and different members in my family have done this, is especially on the private lending side. Mm-hmm. They've said, well, I really want to do this, but I'm a little scared to do it right off the bat. It's my first time. And so my uncle mm-hmm. would talk to his friend and say, hey, listen, I think you should really do this. And my uncle would say, okay, well, I'll do this next loan with you. We'll go in 50-50 on this loan that we'll do as a private loan to JWB. And those guys were just having a ball. It became like a team building, experience. And so when you have a strong partnership, there's this element of kind of going in on it together. I've seen a lot of clients that have come and partnered up and bought turnkey rental properties, and they're doing it together. We even had some folks that did this as an experience because they wanted to learn how to, build a turnkey business either for themselves or to try to replicate JWB. And we said, hey, listen, we'll open up the doors for you. We're transparent. So they bought their first rental properties together. And then since then expanded and now are doing it on their own. So there's a whole lot of benefit on the partnership side. It's one of the more fun ways to do it.
Is that Joe Dela Cruz?
I wasn't thinking of Joe.
No, because I remember Joe has been on the show. He said he started here and then built his own company.
Yeah, Joe did it. I don't think Joe did it with a partnership, but super successful there.
Yeah. Cool, man. That's awesome. All right, great. So that's it. Home equity, retirement accounts, partnerships, 3 ways that people can find capital. And normally they're not looking in those buckets. That's the average investor. Not your average investors can do it. The chat's been talking about a 4th way that has to do with insurance. Maybe we do a show at some point about that, but another reason to show up live and be able to benefit from the wisdom of the crowd here, the community. Real quick question from Mike Foster that I've had him waiting here, but I wanted to bring it at the right time. He says, I know this is controversial, but as we weigh investment risks, right? We were talking about these things have to be risk mitigated. Do you think there is some real risk with rental properties in coastal cities over the long haul with the apparent risk of climate change?
I'm not an expert on climate change. I think I'm like most folks, I think I'm learning. And so I don't want to speak from the seat of being an expert on climate change. But here's one thing that I think, to answer your question, I think there probably is some risk in coastal cities. If you're investing on properties that are on the coast in coastal cities, yeah, I think there probably is some risk there. And that's why I wouldn't recommend that you do that. Typically, the numbers don't even work for you to invest in turnkey rental properties on the coast in coastal cities. But when we're talking about Jacksonville, the neighborhood, for example, that's a coastal city, but the neighborhoods that you're going to be investing are 30 miles inland, right? Yeah. The neighborhoods are the west side, the north side, Arlington and south side, all of which have no last name beach in them. And that's part of why we do that. The numbers, of course, play well in those areas, but it's also nice to know that you have 30, 40 miles of real estate before the coast. And so I think that's something you should look for.
I was having a conversation with I forgot their name, but they're living in North Carolina, right? They're like in Hendersonville and they're thinking about investing down here.
Mm-hmm.
She's from Miami, originally from the DR.
Glennie.
And Glennie, yeah, there you go. So I was talking to Glennie about this, and I'm not an expert in climate change, but I am an avid environmentalist. I was the director of sustainability for a hospital builder. Like I understand, I obsessively read about this stuff, and I'm very environmentally aware. The way that I understand climate change, twofold. One of the things that you say often, which rings true to me when it comes to climate change, is that every area has natural disasters.
Yes.
Right? Like at the end of the day, is the risk of California wildfires any less than the risk of sea level rise? I think maybe more prevalent, more random, a little scarier, right? Like tornadoes, things of that sort in different areas that you can invest are all affected by climate change, right? We only really think of sea level rise as the main thing, but to me, that's the most predictable part of climate change, right? So it's even more risk mitigated. And two is the idea that all the numbers and all the things that are happening with climate change do paint a very bleak picture. They do show that coastal communities will suffer from this, but not all coastal communities are created equal. Mm-hmm. For example, South Florida coastal communities sit on a porous aquifer where climate change is going to affect them much quicker than above Lake Okeechobee, right? And the reason why I say that is because I got in this conversation with Glennie about sea level rise and how it's going to affect stuff, and how I wouldn't invest in Miami because I think that window is too tight for me. But it also gave me the opportunity to tell her that even though that sucks and that's my hometown and I hope it does well, I do believe that if climate change hits Miami in the next 30 to 50 years and causes a major disruption in Miami, I think one of the biggest markets that's going to benefit is Jacksonville, right? Like if there's an exodus of people leaving Miami, it's going to be the working class that leaves first.
Sure.
And they're going to go to the most affordable, closest market that reminds them most of home.
Yeah.
And, when you think about what market that is in Florida, it's Jacksonville. So I don't know, man, there is a risk and there is all this stuff, but I think that there's other ways to look at this thing. And in my, amateur expert opinion, I think Jacksonville bodes really well in that regard, because at the end of the day, the sea level rise you're worried about in Jacksonville is the same sea level rise you're worried about in Manhattan.
Yeah. That's true. Yeah. I never really thought about it that way.
Yeah. So
I'm with you. There's a lot of variables. There's a lot of things that are going to happen over the next, you mentioned 30 to 50 years.
Yeah.
Sea level rise as a part of the decision to invest in a rental property in a established neighborhood 30 miles inland doesn't really register much for me. So
yeah, makes sense. All right, man. I was super pumped for this show because I knew that there would be a reunion of sort in the chats, and there was, right? The reunion from Saturday, the good vibes still pouring over. Love seeing the community still showing up, even though we're all just hanging out together on Saturday for an obnoxious amount of time, having a great time, being obnoxious, but in a good way. So I just really want to thank the community we had about 50 people at its peak here on the show, middle of a Tuesday, after more than 50 of us were just hanging out in person. Really, really means the world to me. Just the connection that we've all developed is a really, really special thing. So thank you for coming on the middle of a Tuesday, middle of Thursdays, and continuing to make time for the show and making this conversation fun.
Love it. Love everything about what we've created. Appreciate you guys. Thanks for making this dream a reality on Saturday and then every Tuesday and every Thursday. So appreciate you guys, and we'll catch you on the next one.
Yeah. And if you want to find places where average investors don't know how to find capital to invest in rental properties, you can't think like an average investor. See you on Thursday.